Hi, everyone, and welcome to the Cliffwater Direct Lending Index quarterly webinar for 4Q25. My name is Fran Byers. I'm head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor. We were founded in 2004, and we are active across the alternatives investment spectrum. Today's format will include Steve recapping direct lending return performance for full year 2025, and then I will follow with a market outlook and discuss how we see the results from the data versus many of the headlines you may be reading. And with that, we'll turn the presentation over to Steve.
Thanks, Fran, and thanks everybody for joining us. I'd like to start this webcast a little bit differently than I have in the past, because I think we need to be reminded as to what the U.S. corporate landscape looks like and what part of that landscape is serviced by private debt. And so what I show here are some metrics in the first column, on the far left-hand side, number of companies, number of employees, et cetera. And then I divide the corporate America into different subgroups. Okay, so if you look at the first blue column, total U.S. companies, basically there are arguably 6 million companies in the U.S., employs 120 million people. I can't remember exactly what total workforce is, but it's somewhere about 135, 140 million. So corporate America basically employs a significant fraction of total U.S. Employment. Then I divide that total U.S. into some subgroups, into publicly traded companies, okay, and in the second column. Then what we're focused on, and that is middle market companies. And I divide middle market companies into institutional middle market companies, okay? Basically those between 50 employees on up. And then next to that, I put PE-backed institutional middle market. So these are the companies, we list 15,000 here, that is really ground zero for middle market lending, which is primarily private equity based, but not totally private equity based. So it's a subset of the total institutional market, but basically direct loans include both PE, probably 80% PE backed and 20% non-PE backed. So my point here is this: the middle market in the U.S. is really important. There are about 250,000 companies in this market. They employ in total 40 million. So that represents about a third of the total workforce, the private sector workforce in the U.S. Most of the direct lending is a subset of that 40 million. PE-backed employs 10 million. So that's very, very substantial. It's not 40 million. Private equity is making greater inroads into that non-PE backed universe. But my point is, this is a substantial market, particularly in terms of employment and generating GDP. It doesn't get the notoriety of the Mag 7, but it is basically Main Street USA. And you can review at your leisure the other statistics, but this private debt servicing middle market Main Street is critical to the lifeblood of the U.S. economy. At least that's my feeling. Turn to the next page. Thanks. So how is that? I break out the PE-backed, private equity-backed middle market and how that is financed. And it's these companies need both debt financing and equity financing. Let me start at the top, debt financing, which we're interested in. So private credit basically provides half of the debt financing for these institutional middle market companies that are private equity backed. Okay. Syndicated debt, 20%, high yield bonds, 10%, and bank lending, 10%. So bottom line, private credit is instrumental in financing middle America, Main Street. In terms of equity financing, private equity funds provide 70% of the financing for this marketplace. Okay. And followed by management, GP or the private equity GP generally take a 5% stake, and they have co-investment partners at 15%. Okay, so combine these two slides. The tale is this: middle market serviced by private debt is really important. Okay. Secondly, private equity basically is a lead steer in providing equity financing to this important market segment. And third, private credit is providing a key financing source for debt financing for this market. So when we talk about the CDLI, the Cliffwater Direct Lending Index, just know we show you a lot of numbers, but ultimately it's basically providing the liquidity, the financing that really drives the engine for middle America. Next. Okay, let's get to the slides you're more familiar with. So again, in the fourth quarter, it's pretty much all good news. Despite rumblings during the year about cockroaches and AI, basically, we haven't seen any really impact on the index or the performance of private debt. In the fourth quarter, really a strong return over 2%. We'll get more into that. And in the calendar year, over 9%, 9.27% to be exact. Pretty much in line with what our forecasts were a year ago. And importantly, just focus on calendar 2025. Still a strong yield. It came down because of reference rates. Fed funds came down, but a 10+% interest income. Realized losses, 64 basis points. That is below the 1% loss rate historically. Pretty much aligned with kind of the losses we've been seeing post-COVID, though. Okay, but there is no uptick. And unrealized losses of 38 basis points. You can see some markdowns in valuations. Probably could be partly a forecast of future realized losses, though very modest. It may also be spreads are starting to increase, and it may reflect that those markdowns may reflect spread expansion. And again, at the bottom of the slide, consistent positive returns on a quarter-to-quarter basis, basically infrequently interrupted by recessions, crisis periods, whether it was COVID, when the index was down about 5%, or the great financial crisis, when it was down about 7%. Next slide, please. And again, what is the value proposition in private debt as represented by the Cliffwater Direct Lending Index? That's shown here. It's basically capturing interest income. Okay, we'll talk about PIK, which is really very minor, but capturing interest income, okay, and making sure that is translates into total return by keeping realized losses at a minimum. The long-term realized loss rate in principle over this entire 21-year period is 1%. Okay, it's been about less than that in recent years, but it's basically capture yield or clip coupons and don't give away anything in principal loss. That value proposition really hasn't changed in 21 years. Next page. Thanks. So what about unrealized losses? Okay. People often say the stock market is a direction of the stock market is a harbinger for the direction of the economy, or at least corporate profits. I believe that's true on average, with about a 6 to 9 month lag. But importantly, unrealized losses or markups or markdowns in private debt, it really is a harbinger for future realized losses. Basically, when these independent valuation firms do valuations, they're looking at the current prospects for those loans, okay, and they will mark the loans down or up depending upon changes in what they think the likelihood of default and recovery will be. That is what has happened historically. So if you look at the green bars, that's rolling 12-month unrealized losses. And if you look at them, basically they precede actual realized losses by about 6 months. Okay, so that's the good news. Unrealized losses really are meaningless in terms of what you actually earn, but they are useful in that they're predictive of possible future realized losses. Okay, so as you can see, every time realized losses in the red line spike down, okay, it was preceded by a spike down in unrealized losses. Okay, so that's the good news. If all of a sudden we're seeing significant unrealized losses, hey, we should be concerned about what's happening on the ground in terms of defaults. So that's good. The other observation is, though, unrealized losses overstate what the subsequent real losses are. And if look here, more than a factor of 2. Okay, so just know that if you start to see unrealized losses, and if in fact, as they have in the past, they harbinger future realized losses, actual defaults, know also that they tend to run very conservative. Okay, and if you look at today on the right-hand side, you can see the really unrealized losses are not material at all. So the private debt market is really not forecasting future defaults. I hear in the investment press, and I see all these headlines. Somebody's forecasting 20% defaults, 15%, all of this stuff, but the market doesn't agree with it. Okay, and so just know that if you see individual prognosticators, basically they're running against their forecasts are running against the market. Secondly, there's been a lot in the news about valuations. Okay, hey, these valuations are not correct. They don't move as much as they should, so on and so forth. I just want to say that valuations move quite a bit in the private debt market, and they're actually more volatile than they probably actually should be, based on subsequent realized losses. Okay, yes, the volatility of private debt is less than publicly traded non-investment grade loans for like the leverage loan index. But those public indices also trade on technicals and the price of liquidity. And that's not how private debt is valued. And investors elect to come into private debt because they're willing to forfeit that trading volatility for some amount of illiquidity. So, from my point of view, and no one has corrected me, that there's a whole argument about valuation. It is a nothing. Next slide. So I close with two slides, which I update once a year when the calendar years are done. I've always said that private debt is similar in quality, as measured by losses, to realized losses, to publicly traded high yield bonds and levered loans. The proof statement to that is this table. And I've circled some of the last 21-year row, and I'd just like to walk through that. So as we know, credit losses are a product of defaults offset by recoveries. And high yield bonds, the impairment rate or the actual loss rate is 1.45% per year. That's the average. Okay. Levered loans, okay, the broadly syndicated traded loans, their average loss rate is 1.01%, okay, on average. The middle market, measured by our Cliffwater Direct Lending Index, is 1%. So if you look over this last 21-year period, basically the same loss rate, whether it's public or it's private debt, both being below high yield bonds. So when people talk about risk in private debt, they also have to talk about the same risk in levered loans and higher risk in high yield bonds. Okay, I only show one column on slide 7 for just the loss rate because it's difficult to get reporting for defaults and recoveries. There are a lot of different types of defaults in private debt, but that doesn't really matter. What's important is what at the end of the day what the realized haircut is. What part of $100 in principal are you not getting? Thank you. Next slide. And then the other table I update once a year is this, where I basically show performance of our index vis-a-vis these other credit indices and also the Bloomberg Aggregate Bond Index, which is an investment grade index. And then I highlight the best year. Who got the best year in this horse race? Okay. And so, if I'm quite honestly betting on a credit index to mirror, I'm betting on the Cliffwater Direct Lending Index. Not only does it win the race, it's basically lap by lap. It's winning, and its consistent return is significant vis-a-vis the volatility of some of these indices. So for example, in 2022, the index was up 6.29%, and the high yield bond index was down over 11. Leveraged loans was also down 77 basis points, and investment grade was down 13 basis points. I'm kind of thinking that 2026 may look pretty similar to 2022. At least that's how things are starting to unfold. Anyway, thanks for your patience with me. Let me turn it over to the star of the show, Fran Byers.
Steve, thank you. So Steve talked a little bit about, he shared a lot of data with you and talked a little bit about sentiment. I'm going to spend a lot more time drilling into how sentiment is actually diverging a little bit from performance, but we'll really drill in here. So clearly sentiment across leverage loans and direct lending has shifted, and it's been driven by several converging factors. That shift began to surface late in Q3 25, following a handful of high-profile bankruptcies and fraud events that Steve highlighted earlier. Importantly, those issues were concentrated in asset-backed finance and the broadly syndicated market. None of them were in direct lending. As we moved into the first quarter of 26, sentiment weakened further. Downbeat commentary from prominent media voices, rapid developments in AI that fueled equity market volatility, and of course, broader geopolitical tensions, including the Iran conflict and rising energy prices, all added pressure to sentiment in the broader loan asset class. Up until this point, though, however, performance in direct lending has held up quite well, as Steve just highlighted. So much of the recent sentiment shift is being driven by fear and uncertainty about what is coming next, not deterioration in realized performance. And so, as always, our goal with the CDLI quarterly webinars is to cut through the noise and present you a very balanced, data-driven view of credit conditions. So flipping to the next slide, let's look at sentiment first starting in the syndicated public loan market. So the chart here on the left shows you liquid loan bid levels. We last shared this chart in middle of 2025 when tariff announcements caused massive trade downs in public loans into the 95 to 96 range amid concerns about borrower profitability. Cyclical sensitive sectors such as autos and consumer took the biggest hit, while the more defensive sectors like healthcare and technology remained relatively resilient. As tariffs were partially rolled back as the year progressed, we saw auto bid levels gradually recover throughout the second half of 2025, even though financial stress actually did occur and persist in that sector. We saw several auto-related bankruptcy emerge late in the year, with tariffs being a critical reason. Fast forward to February 2026, we saw renewed volatility in the market following Anthropic's announcements of new AI tools. That triggered sharp sell-offs across equities and credit, rotating week to week through various end markets, from technology to data providers to insurance firms. Technology, which represents about 15% of public loan indices, saw average bids fall to the 93 context, where they've remained over the past month. On the right, we see here retail investor flows into loan mutual funds and ETFs. They are key sentiment providers in the market, and we can see the takeaway of these pronounced swings during period of volatility. In 2021, strong economic momentum and rising rates drove sustained inflows, while in 2022, recession fears and an inverted yield curve prompted significant outflows, despite the fact that a recession never materialized. We also saw short-lived sharp outflow in April 2025 surrounding the tariff headlines. More recently, following the first brands and tricolor developments in Q3 25, combined with falling base rates, we've now seen roughly 6 months of continued outflows, which only accelerated in the last couple of months following the recent tech and AI sell-off. Flipping to the next slide, we can examine how this sentiment in the syndicated market is spilling into private credit through our CDLI Perpetual Evergreen Index. So redemptions out of perpetual funds in December reached 3.8%, similar to the levels we saw in 2022 when there were macro recession fears. However, as the chart on the right shows, Evergreen vehicles still raised roughly twice as much capital as was redeemed, resulting in net inflows. Now, that dynamic has changed meaningfully in the first quarter of 2026. Redemption announcements have already climbed markedly, and we're already seeing around 4.5% of redemptions through the first quarter, on pace for a record high. And inflows will very likely show a slowing when the report comes out with the data. What's notable is the disconnect between headlines and data. Despite widespread commentary suggesting a private credit crisis, the CDLIP actually finished the year with an 8.3% return on equity and realized losses of just 43 basis points. So the asset class, these evergreen vehicles still delivered a 400 to 500 basis point premium over the risk-free rate, well within historical norms. If we move to the next slide, let's talk a little bit about how deployment activity has resulted from this volatility. Both syndicated loan pipelines on the left and direct lending issuance on the right have slowed as broader market volatility has dampened deal activity. The year began with much optimism in the syndicated market. There were several large underwritten buyout deals, some of which were in the technology sector. But following the AI-related volatility and geopolitical uncertainty, we're seeing here institutional pipelines dropping sharply through March, mirroring exactly what we experienced last year during the tariff shock. Weaker technicals, including softer loan bids, mutual fund outflows, and wider CLO liability spreads have also made transactions more expensive. Overlay that with volatile and uncertain equity valuations, you are naturally going to get air pockets and M&A activity and declining volumes. Now, the silver lining for direct lenders is that when the syndicated market backs up, deals often pivot back to the private markets. So we could see an increase in larger deals coming direct at more attractive spreads, similar to what we saw in late 2022 and early 2023. So we think direct lending actually could see some nice opportunities in 2Q and in the second half of the year. Moving to slide 13, let's talk about how pricing dynamics are adjusting. So single B risk and public loans had tightened to sub 300 basis points earlier this year. It was the tightest level that we tracked in over 5 years, leaving little margin for volatility. Those spreads have since widened to roughly 380 basis points as of late. Direct lending is following a similar pattern. Spreads compressed steadily for nearly 2 years, reaching historic lows of around 450 to 475 in early Q1 26. And over the past month, sentiment has shifted meaningfully. New deals are now starting to close and clearing at the 500 to 525 basis point range, and in some cases are going higher. There were several transactions in the last couple of weeks that were marketed in the mid 400 area, and they only cleared after they repriced into the 525 to 550 spread range. So private credit's actually starting to show better risk-adjusted return, and it's happening over the next couple of weeks. Software credits still remain in price discovery. Many are expected to come to the market in the 575 to 600 basis point range and even higher as the year continues. As the teal line shows, average first lien spreads have already widened 25 basis points in just a few weeks, but we believe more spread widening is to come, which makes the 2026 vintage particularly attractive for those private credit investors that choose to stay the course. With the Fed holding rates steady, investors may once again earn 9 to 10% gross yields within direct lending. And we're also seeing improvements in leverage, in equity contributions, in LTVs, and documentation. So while capital outflows feel uncomfortable, they are actively improving return profiles for disciplined long-term investors. Flipping to the next slide, let's talk a little bit about technology and AI exposure. Now, we normalize borrower classification within CDLI because there's been a lot of stories about managers and how they flag tech and whether they're using the end market. At the end of the day, we go through the entire portfolio in the CDLI and we normalize all the managers. We calculate that roughly 23% of the index is technology related. That exposure spans software, hardware, fintech, transaction processing, servicing. So that's a very wide range within technology. And candidly, software does represent probably the largest portion within tech, and it is for good reason. It tends to be contractual, sticky, and mission critical. And over the past decade, technology has been CDLI's best performing sector, with an average default rate of just 1.4%. You'll also notice that the sectors with higher default rates, in the chart on the left, are intentionally comprising a smaller percentage of the index, which is reflected in the gray line. This exhibits the prudent buy and hold portfolio selection by direct lenders. But investors' concerns are less about history and more about the forward lens. In the public syndicated loan market, tech loan mark-to-market trading levels are showing a wide dispersion, signaling both uncertainty and that the market expects winners and losers. About 15% of tech loans in the BSL land are trading below 80. 80 is the barometer for distressed trading. But candidly, most aren't there due purely to AI risk. Their stress valuations are more so driven by documentation or LME risk, over-leveraged capital structures, weak competitive dynamics, or operational stress. At the same time, only about 60% of tech loans today are trading above 95, which does reflect caution. At the start of 2026, 85% of tech loans traded at 95 or better, with nearly 1 out of 5 trading at par. So clearly the market is parsing through. Savvy CLO managers are looking at names both for opportunity and trying to separate out from names that have high AI risk exposure. Now, potential AI losers can include very commoditized services, low stickiness type platforms, businesses reliant on public data, and companies that are slow to integrate AI. By contrast, many software businesses are actually ahead of the curve, embedding AI to deepen customer relationships, improve margins, and strengthen their competitive moats, particularly those software companies with proprietary data, regulatory complexity, and high switching costs. PE sponsors have been actively improving AI readiness across their portfolios for several years. And importantly, many CDLI software credits are supported by long-term contracts, meaning that an AI-driven disruption is more likely to unfold gradually. It's not going to happen in a sudden wave like we saw during COVID. It's going to happen over several years. And so a lot of the draconian 15% default rates, it's too draconian. It's going to happen, several names over the course of 2 to 3 years. Now, based on this distribution of where loans are trading publicly, investors probably should expect some unrealized mark volatility in the first quarter of 2026, which Steve also signaled to, because direct lending funds do value their portfolios with direction from the syndicated market. And so enterprise value multiple resets are going to happen. New issue spreads are widening. And so we could see some unrealized markdowns, but it doesn't necessarily mean it's because of fundamental credit deterioration. It's more so because of valuation considerations with new spreads and the discount rate. Flipping to the next slide, we can talk a little bit about performance because the data is clear. Across CDLI sub-indices, most managers delivered high single-digit ROEs in 2025. Even after absorbing meaningful base rate and spread compression over the past 12 months, top quartile managers came close to double-digit returns for the third consecutive year. Even 25th percentile managers in our different sub-indices delivered solid high single-digit returns. Now, that fundamentally contradicts claims of widespread 5 to 10% default environments. That math simply doesn't work. You can't have 10% default rates and deliver high single-digit returns. Okay, now public BDC outcomes were definitely far more dispersed and they're clearly more visible. But this reflects structural differences. They have different fee profiles. They have different portfolio compositions. Some public BDCs have subscale portfolios. They have very heavy junior positions that were legacy from when base rates were near zero. These things can increase risk of loss. So these headline small subscale public BDCs that show very poor ROEs is not reflective of the entire direct lending market, although it is notable to see performance no matter what. Moving to the next slide, public BDC share prices, as a result, have continued to fall through the first quarter of 2026. The Cliffwater BDC index now is trading at close to a 25% discount to book and is generating negative 13% year-to-date returns. Selling pressure initially followed dividend cuts late in September 25. That's when it really started. Then it intensified due to headlines. There's also a lot of short interest on some of these BDCs. And we saw a notable exit of what I would call yield tourist investors that had only come into the asset class when they were getting double-digit dividend yields, and for the past 6 months have exited and went to find other opportunities in public equities. So the opportunity and the risk in public BDC investing lies in distinguishing managers that were either penalized by sentiment versus those that are being penalized by performance. Sophisticated equity buyers of BDCs are slowly re-engaging, but your diligence does matter. You need to analyze trading liquidity, portfolio scale, fee structures, and historical valuation ranges all matter. There are some BDCs that simply trade below book value structurally, even in benign markets. Moving to the next slide, I want to start digging in a little bit more on credit health. Now, CDLI covers nearly 10,000 unique borrowers, and it's all calculated based on audited financials. So it's far broader than most headline-driven data sets that you might be reading about. Headlines have thrown out claims of 5, 10%, even 15% default rates. Just to be clear, a 10 to 15% default rate is a GFC level event. That's what we saw in bonds and loans in 2008 and 2000, right? That was GFC level 3 sigma event. That clearly does not align with the recent returns that you were getting in the asset class of high single digit. Rather than relying on a single statistic, we monitor multiple indicators for credit health. We look at non-accruals, we look at unrealized marks, we look at the percentage of loans on watch lists, we look at PIK activity, and we look at realized losses. They're all important, okay? Across all these metrics, the data signals no material deterioration over the past 6 quarters. The notable areas that we should be watching, though, are there is a slight increase in unrealized losses here on the slide over the last 2 to 3 quarters, which we know is going to show up in the 1Q26 results. And the loans marked below 90 metric does suggest a modest uptick in realized losses may emerge over the next few quarters. But both of those metrics are foreshadowing future realized losses are only slightly higher than what they were the previous 2 quarters. It's very minor. There's no meaningful stress here. Moving to the last slide, I want to dig a little bit deeper into the marks below 90. Now, roughly 6% of the CDLI has marks below 90. We would consider 90 kind of, those are names on the watch list and the early warning list. Consumer and retail, which also includes autos, is showing the most stress, with 9% of the loans in those subsectors marked below 90. Clearly, this sector is tariff impacted and more indexed to consumer spending, so it should probably have the highest amount of stress there. Healthcare, surprisingly, a more defensive sector, isn't close behind. 8%, which is notable, is below 90, and healthcare drives 18% of the index. Healthcare non-accruals in Q4 2025 were concentrated this quarter in a lot of physician practice management businesses. This includes dental and home health. There was a couple of big names that went on non-accrual this quarter. Dental can be particularly challenged because it is tied to more discretionary consumer spend. So it almost kind of fits into the consumer bucket versus some other subsectors within healthcare that are more recession resilient. But even there in the healthcare sector, even though we've seen an uptick here, the trailing 4-quarter default rate in healthcare is 1.8%, slightly higher than CDLI at 1.5%, but still modest by historical levels. I think Steve shows his data shows 2 to 2.5% is the long-term average. So we're still below the long-term average. Food and beverage and media are also facing some modest secular pressures. Those both of these remain very small exposures within direct lending and within CDLI. So food and beverage, again, is being impacted by tariffs and margin compression. And media is going through a secular transformation due to the rise of social media. Looking to the chart on the right, PIK levels have not only stabilized, but are improving as base rate declines. So we've seen a ton of articles that PIK is at an all-time high. This chart shows that PIK is coming down. I ran the PIK 10 different ways, and it's showing that it is coming down. This chart shows that percentage of PIK loans where the PIK rate is turned on greater than 2% fell to only 10.3% of the index from 11.4% last quarter. That is an improvement. Why is it improving? Because base rates have come down, because yields went from 12.5% to 9%. which is alleviating borrower stress. When we look at PIK loans marked below 95, which is basically a good barometer for your amended PIK, it does equate to around 2.9% of CDLI. Now that is slightly elevated versus where we were in 2024 at 2.5%. But we're far from distress levels. So overall in CDLI, PIK is coming down. However, the amended PIK showing a little bit of 40 basis point increase year over year. So in conclusion, the headlines are loud and sentiment is fragile, but the underlying data remains resilient. So the opportunity, as always, lies in being selective, being disciplined, and staying anchored in the fundamentals. Thank you for your time and support. Turning it back to Steve.
Thanks, Fran, and thanks to everybody for joining us today. As always, if you have any questions, please contact us. We'd be glad to help you. Thank you very much. Talk to you in 3 months.